people are buying that for speculative reasons, right? They speculate for a variety of different reasons that at some point in the not too distant future, the gold will be higher. They're not buying it because gold's earnings went up.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I am not, as of yet, joined by the Brain Trust himself, Mr. Chase Taylor. He's going to be joining us. I'm actually confirming that right now. He's going to be joining us in about 10 minutes after we get through our first segment here. Obviously a lot going on. Metals kind of at the top of most people's minds, and rightfully so. Big moves shouldn't be surprising. The volatility's been nuts. The vol we've seen in the contracts for silver and gold have been ballistic, especially silver. And this is part of a feature, not a bug, right? Like we've been telling you, you're going to get these big runs. We're going to get sell-offs. It's bound to happen. So we're going to walk through all that. We got a new Fed head that got announced this morning. That's what we need. We need Chase on. Let me finish this here. To discuss this, Kevin Warsh, a little bit of I know he was one of the guys that was floating around. I think most people thought it was going to go to Waller, especially with his last vote to cut rates. But I don't know how much of a surprise that is. The other thing is you're going to see the headlines: gold crashing because of Warsh and all this kind of stuff. So first of all, gold's not crashing. Second of all, one of the things we told you is when things go parabolic, this is what they do. And if you look at stock markets, you can see it. And the reason things happen like this is just because of human beings. Right? You get a group of people that start buying a stock. Okay, let's say between $5 to $7, right? $10 is a round number, and it's also double 5. Well, so what are people going to do? You're probably going to hit some resistance at 10, right? It's the way people think. They want to make their double and take it off. Or like I've talked to you guys about, a lot of professional money managers, when we double a stock, we'll sell our original position or half. Right. So there's structural reasons for this. This is why the people that completely turned a blind eye to technical analysis are wrong. It should, in my opinion, should be looked at. It should be, a piece of the information, because the chart of a stock tells you a lot of things. Now, typically parabolas should not be bought, but I would say speculative parabolas. Okay. Like if you go back and pull up a chart of NVIDIA, it goes straight up. It's going parabolic, right? But the parabola was that's kind of like what I was saying is a re-rating. Now, I have said gold was re-rated too. Let me explain that. But when NVIDIA was happening, right? What were you? You were increasing their revenues by 250%. So that wasn't speculation, right? That was the market, and I didn't adjust to this quick enough and didn't see it quick enough. Full admission there. But that's the market adjusting to a new reality. The stock has been rewritten or re-rated, right? So that's not just a speculative parabola. When you watch gold or silver go up like that, that is what they are, right? That is now where there's supply constraints, yes, but there is no coincidence that silver started acting like a dodgy crypto coin, right about the time that you saw a wave of Chinese retail money and generally speaking, Asian money flowing in to metals and metal ETFs. So, people are buying that for speculative reasons, right? They speculate for a variety of different reasons that at some point in the not too distant future that gold will be higher. They're not buying it because gold's earnings went up, right? So whenever you see speculative fervor hit and you see a parabola like that, now the tough part is identifying where the top of that parabola is. Now I'll kind of give you guys insight to this. I was playing with fire a little bit, and I'll be honest with you, it was one of those trades that I kind of regretted right after I put it on. And I think we talked about this on the show last week. It might have been earlier this week, man. This is kind of a classic example of there's weeks when decades happen, right? Maybe it was as early as this week or late last week. But what I was saying when gold and silver were mooning was the thing I don't want to see. What I would like them to do at the very least was to hit 5,000 for gold and $100 for silver, and to struggle there, right? Those are big levels, right? Remember what I was saying, $5,000 gold, the people that bought at 2,500, they're going to want to sell some. We all heard tons of people taking profits on silver at $100, right? It makes sense, right? And I go, now what will scare me is if they push through those levels and then moonshot up. Why? I don't know, doing these things for too long because, or watching these things for a really long time, because when you have these levels, and just so you guys know, in the world of, I've been hearing about $5,000 gold since I was 5. I've been hearing about $100 gold, silver for the same period of time. These are huge levels, huge mental levels, right? And then when you look back at how quickly those levels were, right? It's not just the altitude we reached, it's the velocity in which we got there. And that's always true in finance, right? It's not the move, it's the pace of change that gets you. Meaning, right, 3% inflation over 20 years isn't a problem. Right? Now add that up, that's like 60, what would that be? 3%. That's like 75% inflation. Sounds like a lot, but you spread it out over 20 years is not a problem. Put that into a 3 or 4 year space, that's a big problem, right? So pace of change matters. But the trade that I made because of that, and we saw that little bit and then broke through 50 and then just took off broke through 5,000 for gold. Silver breaks through $100, takes off like a scalded cat, both of them, right? And, it's always tough to do this, but because we've been in literally this entire gold move, we got it from the start. And, when you're up 15% on the year, 27 days into it, in my opinion, you got to play a little defense there. And so I hedged out about 65% of our gold exposures yesterday, just by shorting gold. I was still net long our gold positions, but covered about 2/3 of them. And I regretted it afterwards because, the move that you're seeing down, like, am I happy that hedge is up 20% today? Yes. But I didn't own the metal. We own the miners. And like I've told you guys, the miners are undervalued at $3,500 gold. And like I said to you, don't expect the market to pay attention to that when gold gets hammered. The miners are going to get rinsed. That's what's happening. But the reason I said that is because typically when you do that, when we know what the reality with the miners is, typically doing any hedges like that is just going to reduce your gains. Typically. Why did I do it? I kind of felt like I felt like there was not a lot of downside there. This $5,000 is a big level. I did not believe gold was just going to take off and just keep elevating, hit 5 onto 7,500. So I also took just a stab at it. We had a very tight stop on it. But and we had guys, we had a guy on our team that whose opinion I respect infinitely or immensely, didn't like the move. And I get it. And that's kind of one of these things where I think sometimes you have to go with your gut. And for me, if you guys can't tell, it's either a really bad podcast content or really good. I'm not sure, but I'm kind of walking you through. I'm kind of doing the postmortem of the trade myself because it's easy to sit here and it's 20% up today. We already took some big profits on it, or some nice profits considering the duration of the trade. But it's so you're happy about that. But at the same time, you're always looking back and going, did I get the execution right? Was that the right thing to do? In my opinion, it was, because of where we were. The other thing that I've learned to pay attention to, and this is really anecdotal, so take it as it lies. Whenever we are in a big trade, like we've been in gold and silver miners and stuff like that, if ever we've got a big allocation to something, you're always going to watch it closely. And we're not going to do that. We're managing retail money. So it's not like Druckenmiller. We're not going to put it all, in one basket and watch the basket closely per se. But, if we've got 18, 20% of the value portfolio on one idea, even though it's in different names, right? If it's in gold miners, if I got 18%, 20% in gold miners, they're really volatile. That's a big deal. I got to keep a tight eye on that. And when you watch these things really closely, what I have learned, when I've got those big positions on, what I like to do is I like to game plan. I like to envision different scenarios and what I would do. And one of the things that I had talked to Chase about was if I see that pattern of gold and silver not hesitating and respecting what should be natural resistance lines for them, and more importantly, if they moonshot off that level, I'm going to hedge our exposure. And the reason I said that, this is, like I said, it's totally anecdotal. My experience is when I've seen that action, when they knife through those places that guys like me are saying are going to be resistance, I think that's when max FOMO hits. People are like, they're not stopping at 5,000. I'm going to miss the train. Bid, right? Again, totally anecdotal. I'm just telling you what my experience is watching these patterns over and over and over. And what is it's very rare. Now, remember, I had the call. I thought gold had to go back and test 3,500 or 3,000. I'm still surprised it hasn't. It may. Okay, but it's not 5,000. And I'm just telling you, markets are made up of human beings. So silly things like that matter. And then on top of it, the historical importance of those levels. Like I said, got gold miners and gold bugs have been talking about $5,000 gold since I was 5. Since I was a little gold nugget sitting on my dad's knee, right? Same thing with $100. So it's just, I could have been wrong, easily could have been wrong. The other thing that I'll say to the contrary is you never want to short something that is in a bull market that should be in a bull market, right? Look at the setup of the last 15 years. Is anybody surprised that gold and silver are making generational highs? No. Surprised it took so long. So when something like that is happening in a world where you've got $85,000 Bitcoin and you're shorting gold, that's audacious. Okay, but then you flip around, look at what we made in gold, right? So I just, that hesitancy, like you guys are, you don't like to give wins back. Now, would I advise other people to do this? No, I don't even know that I'd advise me to do it again. But like I said, the one thing I've learned is you have, at least for me, and everybody's different, but when I sit down and I've got a very concentrated position and I make out a game plan ahead of time, whenever I haven't stuck to it, it's bit me. And I think part of that is because you can think more clearly, and we just got joined by the man himself. He's on. And I'll finish this thought, but I think part of it is you can think more clearly when you're not in it, right? Like anything else. So it's why, NFL teams script plays, and it's why we script game plans. So when the chaos hits, not if, but when the chaos hits, when the emotions hit, when the adrenaline's pumping, when cortisol levels are up, you're not just playing it loose like that, and you can play it more surgical and more cold and more steely and hopefully make better decisions. The flip side of it is that at the end of the day, nobody knows for sure. And, I could sit in here and look, there's a lot of people. Chase will probably start laughing. He doesn't know what I'm talking about yet. He'll probably figure it out pretty quick. But there's a lot of people out there that would be coming on the coming on the podcast today and being like, we told you when this rally started. And we also told you to be careful. That's why we shorted gold yesterday. And that's why you can't listen to anybody else, because we're the only ones that know where gold is going. That's not it at all. There is no right and wrong. And like Chase will tell you too, I think one of the biggest mistakes that's made in this game is that people ascribe a level of genius to whoever want to trade, where you sit there and you look at it and go, guys, it's a binary outcome. By definition, somebody had to win and somebody had to lose. And just because you're on the winning side of one does not mean you're the better investor, doesn't mean you're the better trader, and it doesn't mean you're going to have the better career or make more money, right? And it doesn't mean you're a sage. If you've got a binary outcome and you bet one side or the other, somebody's going to win. It's like, right, it's just by default. And so I think one of the biggest things that we can do is ascribe genius to that. And I apply that very much to myself too. So I was just walking them through what was going on gold medals and all that kind of stuff. And I was kind of doing a post-mortem with them, Chase, talking about when I put that gold hedge on yesterday. I'm still not convinced that was the right thing to do. Obviously, it gave us a good bump yesterday, but I think, it was one of those trades that I thought I might have regretted right when I put it on, just because we're not long the metal, we're long the miners. And, like we've said, and that I firmly believe and know, is that these miners aren't priced for $3,500 gold. So why am I worried about them selling off because gold's dropping from 5,000?
Because
but
they will. And they did.
What gold and silver were doing, in my opinion, and you and I talked about it. Remember that conversation we were having where I was like, I really hope they take their time and really toil. And you and I were both saying this. We hope that they take their time and really toil with the $100 and $5,000 levels, because the only way this is going to be sustainable is if this slows down and consolidates some, right? And then I said, the thing that worries me the most is if they break through those levels and then moonshot from there, just because to me, that is the classic FOMO pattern, right? Where it's like, everybody thought they were going to struggle at 5,000. I was waiting for a pullback. Now it's at 5,200. I better buy it before it gets to 6, right? Like that's the, that emotion. And I said that if we saw that happening, that would really concern me, because then I figured that would be a telltale sign that we're about ready to get smashed. That happened. We put the short on, turned out pretty good so far, obviously buffered us today. But I was talking about the downsides of doing that. I did a similar thing and I was too active, where I was hedging energy producers at the end of 2022. And I shouldn't have done that. I should have just let them run. It ended up costing me gains, right? And that gold hedge could have done the exact same thing. What are your thoughts on it? I think it's an interesting topic because, like I said, it was great today. The hedge was up 20%, but I'm still not, I'm doing the post-mortem on it, and I'm still not convinced it was the right move.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
And we are back. Thank you, Riverside, for your daily malfunction. I hate this website. I need to find a viable solution. Anyway, back to our discussion. Gold and silver, talking about, the age-old argument, right? To hedge or not to hedge. And like I said, I was kind of still doing the post-mortem on it, wondering, because today it feels good. Your hedge is up. I mean, we still got smacked around pretty dang good. Worst day of the year for sure for us. But definitely that short definitely took some sting out of it, that hedge. But talking about like I said, whether it's the right thing to do, and the reason, what pushed me over the edge, what I was saying is that in my experience, when I sit back and kind of create a plan of action, if you will, about how I think a thing's going to play out, and if it does this, I'm going to do this. In my personal experience, whenever I've deviated from that plan, it's cost me. And what sold the deal for me to put that trade on yesterday was the conversation that you and I had about my concerns about it breaking through the $5,000 level and then moonshotting from there. And like I said, it works out good. The vast majority of the time, hedges do nothing but limit your upside, right? And bring down your alpha. There's other times where it can really help. What are your thoughts on that? It's something that, even though it worked out in my favor, that I don't know that I'm sold one way or the other.
Yeah, I'm sold, and not at all because of the resulting aspect. Like, for me, I earned this in the fire. You either have a respect for parabolic rises and how bad they can hurt you, or you will in the future. So if something's going well, like, I don't feel like I need to hedge, even if like the gains are there or whatever. But if something's in a parabolic rise,
Yeah.
That's just a different ball game. Now, we were threatening the parabolic rise whenever we put that hedge on, but we hadn't busted it, which is dangerous, like, because it can instantly be, up the 10% instead of the down 10%, quickly. Trust me, because my PA side, I took 3 different stabs at shorting silver before it worked. So, like, those weren't even small paper cuts, like, on the first couple times. It's just, but I've had parabolic rises blow up in my face. So I just know what it feels like. I know what it looks like. I know what the people talking about it sound like. Like, there's never will you have a more intoxicating narrative than in the peak of a parabolic rise.
Yeah, and you get your biggest moves at the peak too.
Right. And that is an argument for being as patient as possible. And to be clear to everyone listening, like, I was getting nervous, call it 6 weeks, about 6 weeks ago is when I really started to grow concerned with especially silver's rise. Now, we went up a lot from whenever I started to get really concerned, to put it all in perspective. But as you can imagine, like, the trend line is like here, and then it's here, and then it's here, and then it's here. And then you get to the point where it's like this, and you have to zoom in on a 1 hour chart just to make it all make sense. Usually when it's to that point, like, it's just a matter of time, because not only does everyone in retail every CTA on the planet is max long, because they have to be. It's just by their rules.
Yeah.
And we talked about it on the show in the last week. Like, eventually something breaks it, and then the same reinforcing loops that pushed it up pull it down. It's almost like a physics math problem type thing at that point. And so from my perspective, having a short on made total sense, knowing that the odds of breaking the parabola, maybe they're not 80%, but call them 40%. But the thing is, like, the impact, even if something's low probability, the impact is so big to your portfolio, you almost have a duty to put on that hedge. So low probability, high impact stuff is literally what you're there to hedge. As I always say, like, risk isn't what's probabilistic. Risk is what hurts the most if it happens. And for us, in the way our portfolio was constructed, what would hurt the most is unhedged, having commodities, especially precious metals, go down, as it turns out, 26% in a day, as silver did, and gold, 8 and change. And at one point it was over 30 and over 10. So because the risk to us was that, hedging made sense. And as we tested the bottom boundaries of a parabolic rise, and we knew the structure of everyone and their dog being already in that market and telling you that you should be in that market, or asking you if they should be in that market more, or whatever. Like, I put on.
Well, and remember when I told you? Yeah, remember.
Go ahead.
Yeah, go ahead.
So I saw $500 silver calls yesterday and $8,000 gold calls. And those always come in these moments of extreme optimism and parabolic rise. That's where everyone's like, oh yeah, well, this is, clearly this is going to go, to the other side of the moon. And if there's ever been a double kill zone for price action and narrative, it's when you're in a parabolic rise and Wall Street starts to extrapolate the whole thing. Sorry, go ahead.
Yeah, no. And this is one of the things that, people probably sit there and listen to us sometimes, and every time you bring up the word anecdotal in investing, it's kind of like sneered at, like, oh, that's just anecdotal. I don't want to speak for you, but I know that you're a fan of anecdotal information, and so am I. Why? Because markets are made up of human beings, not computers. I mean, computers play a big role too, but human behavior is a lot. When I start getting DMs and emails from people that I haven't spoken to in years, asking me if it's a good time to buy silver, I'm getting out of the way every single time, right? And this is like, if you could hammer one thing home to people, if you do not do this like you and I do it every single day as a profession and all that kind of stuff, when your buddies at the water cooler, and here's the problem, crypto made a lot of bad habits, right? Like crypto worked. Like if you want to like think about like somebody being in the weight room, crypto was like the guy that only does curls with his right arm, right? You know what I mean? Like, yeah, you're going to build some muscle, but it's going to look pretty ridiculous at some point because you're not doing this correctly. And it's going to cause more issues over time than it doesn't, than it doesn't fix. And anyway, what I'm saying is the way that you got max utility out of your crypto positions was by not managing risk at all, right? And if anything, like laughing in the face of risk. And I think like I said, I think it created a lot of bad muscle memory. And what you have to know is that the vast majority of the time, when people that do not do this for a living are giving you stock tips, that in and of itself should be a warning. Why? Because it tells you that non-professionals are making a lot of money. Usually non-professionals only make lots of money in speculative frenzies. How do you know they're making a lot of money? Because they'll tell you about it, right? That's why they're telling you about the trade. They're not telling you about the trade. Notice, right? Who do you think got listened to more 18 months ago? The people saying that Bitcoin was going to 1 million, or the people like you and I that were saying, hey, we think gold could break above 2,500 here and really go off to the races? They were listening to the people talking about Bitcoin going to 1 million, right? Now, all of a sudden, gold crosses over 5,000. Bitcoin's garbage. Everybody's diving into gold, right? It's just, like there are going to be exceptions to the rule. But I feel like this is one of those lessons where if you heed this advice, you're going to come out better 8 to 9 times out of 10. Do you think that's fair?
Absolutely. And it's funny you mentioned crypto because one of the things this reminds me of is 2018 crypto. Because I'll never forget having a guy I worked with who knew nothing come up to me at work and start talking to me about Bitcoin. And this is after it had really run. It was in a parabolic rise. And it was because that was when I went out. If people remember Long Island Iced Tea Company. They changed to a crypto company and it went up like 500% in like a week or some crazy nonsense. And then I had that guy come up to me and be like, dude, I don't know how much Bitcoin you got, but it needs to be more. And I know this guy like probably learned what Bitcoin was 8 minutes before he talked to me and had the IQ of Bean Dip. So I was like, all right, I'm going to short Long Island Iced Tea Company. So
yeah.
And I say this with humility because in the 2011 silver blow off, that tore my limbs off and beat me with them. So that was one where I was the retail guy that didn't know anything, calling people and be like, have you bought some silver? Because if you're not, you better. When it was $48,
Yeah. And I say this not as a brag at all, because it really was lucky, but at the same time, I was following my game plan, like I was saying before. But we made a lot of money coming out of 08, 09 into 2011 on the gold and silver trade. And we kept the vast majority of it. It was when gold was still between 1900, there right toward the top. And I pulled way back on our gold positions, but it was because I thought it was overrun. I thought gold was beginning the march to 5,000 back then. And I thought it had been overrun. And I'll share the reasons why in a second. And I pulled out expecting to get a better entry price in. I took a couple shots at things here and there, but I didn't get back in because I thought gold was going back down to 1,100, which it eventually did. Didn't get back in. I just never got an entry. I never got an entrance, where I felt good. Now, what's funny is, again, another piece of anecdotal information that saved me from that. One of the things that you'll see in, I shouldn't speak for everything. I'm assuming it's this way with mining all kinds of metals, but specifically in gold properties. One of the hallmarks of the top of a bubble, and you and I have talked about this before, is there are gold properties that have been operated at one point or explored at one point that didn't work out for this reason or didn't work out for that reason. When you get to the height of bull markets, what you see is those old properties that are defunct and have been thrown around for 30 years and have probably been in 3 or 4 different public entities at some point. You start to see those getting financing. When you see those projects and those deals getting financing, step back, right? Or you see investors starting to invest heavily on like feasibility studies, right? Or like mining plans, as if the mining plan is like a guarantee of some kind. Anyway, you see it's different anecdotal, but it's the same, right? It's like, well, everybody knows gold's going to 2,500, dude. Like you're like, that's not when I want to be in this sector, right? I want to be in this sector when everybody's like, gold's not going to 2,500. You know what I mean? Like that's, right. And it's that speculative
cyclical sectors. You want to be when no one's putting money into it, and you want to get out whenever the capex just starts flying.
Yep. And I think valuation is a big aid. Like you and I have talked about, not good on a timing thing. When you're trading a sector like this, I think it can be used a little bit more on timing in a situation like this. And the reason why I say that is look, I think gold has been re-rated higher. I think gold will be higher than it is today 3 years from now. I don't think gold is going to 12,000 in the next 2 years. I think that it makes a lot of sense for gold to maybe trade in a range of 4,000 to 6,000 for a while, 55 or whatever it is. I'm not one of these crazy people. Yeah. But look, there's you can't pop the hood on gold and tell if it's overpriced. Nobody knows where it's going, right? And so I think looking at the valuation of miners in a situation like this is a wonderful window into sentiment. I also think that looking at the fundamentals and the valuations of the miners is like one of the only things that you can know for concrete. And look, I do not like my portfolios being down any day. I will say this, that so far, and I would say a retest of even as much as 4,000 on gold, I would be cheering it. And the reason I'll be cheering it is because the miners are going to get slaughtered. Today's a perfect example. Miners getting absolutely just
right, yeah,
hammered.
They were down more than 4% more than gold itself.
Yeah, right. Okay, so right. Now remember how we were talking about gold isn't even priced for 3,500? We said gold is going to be the baby in the bathwater. Or gold miners will be the baby in the bathwater. Gold starts dropping. All of that talk about how undervalued they are will go out the window, and those people will throw that stuff overboard as quick as they bought it. Okay, well, what do we know, though? We know about what the underlying valuation case is. And, if we're long-term value investors, like I said, it's not fun, but we should be cheering a move like this. I looked at a couple of our favorite names today just getting thrashed, and I just was sitting there going, perfect. Keep unloading them, baby. Keep unloading them, right? And I think that's the way you have to look at these moves. And I don't think, I know that's how you have to play moves and things like gold and silver. You're going to get run over.
Yeah, absolutely. I think, and that's why it's not fun to watch things you like go parabolic, because
right,
it just makes the management of the process very difficult. But
so much harder.
But this is so far is going about as good as you could have it go. You throttle down positioning, you put on a hedge, it pulls back. You're not going to get it right on where the pullback ends, but if you're directionally correct when you start putting it back on, and it as long as the broad stuff continues to work, is if their costs explode, you have a problem. If they don't, you're probably good. If the metal doesn't keep going down, medium term, it all works out in the end. But yeah, this is why investors should pay very little attention to 1 week, 1 month, 1 quarter, 1 year returns for the for a portfolio like this.
Right.
We had some weeks where we blew the S&P out of the water, but we have a lot of concentration compared to other people in commodities, and now we're going to have some give back.
Well, you and I were talking about this just the other day, and this is another thing you just have to learn. It is awesome being on the other side of it when you're outperforming the market by 100 to 150 basis points every single day. But you just have to know, like the price to do that is going to be times, and they almost always last longer than you can absolutely bear, right? Like it's take your the max period of strain you can possibly survive. I guarantee you those drawdowns are going to go a couple days past that point, right?
Oh yeah.
Get the full shakeout, man. Yeah, it's just it's the nature of the beast.
And this is also why we've been talking about the threat of the dollar going up being a potentially problem. And it was up 1% today, played a role here. Long-term bond yields were up, played a role here. Not only did we trim up precious metals and do some hedging there, but we did a little bit of trimming in our emerging market stuff. That stuff all took a header today as well, especially LATAM, because, if you think about, there are places like Vietnam, it's an EM, but it's not going to get blown up with commodities. But Latin America, that's this metals central. So you don't get a metals bear market without LATAM just, getting its teeth knocked out. And sure enough, like you saw some of that today. So a lot of those correlations are very real. So we brought some of that risk down. So if you think about, if we went in today full boat where we were a week or two ago, I don't even want to know what that number would have been.
Yeah. No, Whew. Yeah. The importance of following your plan though, too, right? Like you and I talked about, especially when you're going to overweight, right? When you're talking about just holding static allocations to individual sectors and rebalancing on it, like you don't have to worry about any of this, right? But if you want to go overweight, if you want to grab alpha into a sector, you got to do that. If you're going to run that overexposed, I mean, what is the right there at our max, I think we were at 20% gold miners in the portfolio, something like that. 18.
I think 17. With most of the time, we were running right around 13.
Okay, but I mean, we were probably, when you look at the rest of the book, we were probably running around with the equivalent of 25 all the time. Right. And we had stuff that traded right with it.
Copper and aluminum and uranium and stuff. Yeah. You're talking 30, 40% at times. Commodity or commodity adjacent stuff.
Yeah. And when you size something up like that, in my opinion, in a portfolio like we're running, and you start ripping, you got to take risk off the table. You just have to.
The way I see it, if things are going pretty good or pretty bad, like you're okay. But if things start going just fantastic, and it feels easy, like you have a problem, like because the flip side of that is the mirror image of that is just as real. So if things start going too good, like you have too much risk, and like that's why we did what we did.
Yeah, like a good bull run to me is when my positions are up 1.5%, 2% a week. You know what I mean? I mean, hey, that's a great week. I'm not sitting here saying it's not, but it just that
by 80 bips or something.
Just grinding, right? Because and that's when you and I would just start talking. The minute you go, okay, this is cool because our stuff's going up, but that just means we're gonna have a bigger drawdown, and it just means it's gonna be longer until the bull market resumes, the way it does. And it's like that's why we can't have nice things, man. The idiot's got to get in there and bid stuff up. Okay, so pivoting a little bit here. Want to go over, well, we're going to talk Fed, obviously. But before we do that, I think the RAM shortage going on right now is something not enough people are talking about. Obviously, inside the industry, when you look at stocks like SanDisk and Micron, you'll see it there. We've owned Micron for about, 2 months, something like that?
Something like that. Since their last earnings, whatever that was.
Yeah, whenever that was, maybe a month and a half ago, something like that. Anyway, SanDisk has gone up a lot.
To say the least.
I was contacting my buddy at Microsoft who was on the podcast, and he's texting me back. I haven't had a chance to go over his text, but I was asking him some dynamics of this stuff. The one thing I can tell you is he thinks that this memory shortage is a real deal, and it's got legs to it. It's not something that's going to be resolved overnight. So, you and I were having this conversation. If you look at a chart on SanDisk, it makes you want to vomit. That if you look at the underlying fundamentals and then look at the stock, on a forward basis, I think they're priced at like 6.5, 7 times sales. And their forward guidance was nothing short of stellar. Um, what is we? You know, it sounds silly for me to say this. I know what the implications are. I'm aware of the shortage, all that other kind of stuff. Um, Obviously, we bought Micron, but here's what I don't really. What? Why is there a shortage? What? Why does it take? Why is there? Why isn't there an ability just to turn the machines back on and you want some RAM? I got here. Here's some RAM. You need some RAM. You got some RAM. Here, you know, I'm not. I have zero familiarity. Again, we're invested. I understand Micron. I get all that stuff. But this particular situation, I don't really think I understand the genesis or the dynamics driving it.
Yeah, so I am whatever the opposite of a memory expert is. I'm that. Uh,
So that makes two
but
of us.
my understanding though is like if you think about a lot of this stuff is like kind of old compute world that we kind of got away from. Like you didn't really need this stuff anymore. Uh, a lot of legacy hardware type stuff was plugging into this, so it became like like a bad business for these folks. And then next thing you know, AI creates a new source of demand for it, and I think the industry was pretty skeptical for a little while. What's
What
funny,
about AI? What about AI needs RAM? I mean,
I know inference itself needs memory. Like I'm sure the whole thing needs memory. And there's like all there's DRAM, NAND, there's HBM, and I barely understand what this stuff means. Um, so as far as the manufacturing of this stuff, like it was a bad business. Like so they stopped doing a bunch. And as demand picked up here for this, it was a lot of them. I think were kind of like, like do we really want to spend billions to build more of that crap? Like, it's something that had bitten them. So I think just now they're, lately they're like, oh, okay, well, like we got to get in there and build this stuff. Like this is actually real demand. It isn't necessarily just going to vaporize. Like, it's kind of like a Charlie Brown football thing. They've had a few moments where they thought they needed to build capacity for this, and then Lucy pulled the football and they fell on their butt. So
well,
it created the perfect storm.
Isn't RAM? Look, right out of the gate, if you guys if people think that they're like this statement is gonna like unveil me as being a complete idiot when it comes to tech, that should be baked into the cake. This is why I hire the people that I hire. Like this is not my ball game, but isn't RAM what drives like search, right? Like, and the reason I say that is one of the ways I became familiar with the term RAM was because when my computer was running really sluggish and the searches and the queries were taking a really long time, I knew I needed to restart it, reset that RAM, right? And then it fired off. Is RAM the part of memory that drives search?
I have no idea.
Random access memory. It sounds like it should.
I'm not going to insert foot in mouth on that one. I'm not sure. So I pulled up on here just to like learn a little bit. Basically, the hyperscaler like AI training and inference stuff that they do, it started pulling like more of this, and it like away from like traditional servers. So the AI build out essentially started to absorb an outsized share of just memory output. So like, and we talked about this a little bit in the show, like where like now they're like, ooh, we might have to chill out making TVs. Like literally,
It's just a demand
TVs.
shock. It's
right,
a demand shock.
Yeah, because it's pulling it away from other stuff. But
got it.
The people that make it had sidelined it because they were getting way better margins for other areas of memory. So this memory was the bad stuff for them. Now all of a sudden it's the good stuff. So like where it makes me nervous from the investment standpoint is like I've similar to the silver thing. Like I've seen this movie before. They will get around to it, and then the price will freaking collapse.
Right.
And then these companies will probably have a really bad time. And what makes me nervous is like we're highlighting really well right now. I don't know this industry enough to know that point. I know it's going great now. I know they don't have enough, and I know that they're going to print money for a little while. But how much is that is in the price? Because like obviously, if they were going to print money for the next 15 years on this, then there's no wrong price for SanDisk. But if they're going to print money for 2 years and then go back to getting smoked, then then what are we talking about, I guess. But and the funny thing is SanDisk was actually spun out of Western Digital, and probably, and I don't know, I'd have to read about it, but probably because it was like the crap part of the business, like this, get it off our balance sheet, and now all of a sudden it's like the rock star. But
Well, I don't know. It might have been unrealized value. It'd be interesting to go back and look at that deal.
Yeah,
They
I'm
might
gonna
have
look it
spun it
up.
out for opposite reasons. But yeah, so they had impressive numbers. Went over the app. I don't think we talked about Apple yesterday. We did very briefly. The earnings came out. You know, the headline numbers: 16% sales surge. Da, da, da. I haven't dug through the queue, but I will tell you that I think the market's pretty good at pricing these things out as it relates to a company like Apple, because it's not very complicated, and you don't have they're not making Optimus robots that'll be ready for sale at the Q4 this year. So, right, they don't have quite the nonsense surrounding them. But I think you've got to look at that quarter. I would encourage nobody to be sucked in by that quarter and think something's great there. That quarter has a one-off written all over it. That sales surge can only be because of that giant batch of phones that they flew in there right before the tariffs hit. That's the only thing that makes any sense. I mean, because you want to talk about a consistent chart, go pull up the reduction of market share in China. What's that?
Wouldn't the tariffs be coming here? Not
China? I can't remember exactly how it was done, but don't you remember how I want to say it was like 3 planes Apple filled up with shit, pardon my language, to build the phones. I don't remember the exact, we got to pull up the story again. I remember we talked about it on the dots, and Apple flew a bunch of stuff to China, or maybe they flew it to China. I thought, no, it was from here to there. Well, I'm telling you. Anyway,
the sales are great, and they're saying like the reception on the new iPhone is like really good, and people are really liking it. And they had the best quarter they've ever had there. Obviously, one more quarter will tell the story of whether or not it's a one-off, but
yeah, there's nothing new with that phone. I just don't buy the narrative. There's nothing new. There's no functionality. I just don't buy it.
To me, but
no, and you want to look at one of the most consistent charts over the last 5 years. Go look at drop of market share for iPhone in China. There has to be something weird going on with the tariffs, or something they did, and the market seems to be taking that view too. I mean,
it doesn't have to be though.
I understand that. What I'm saying though is, when you're looking at a company like Apple that's got as much look through, as many people following it, if they were back to all of a sudden double-digit sales growth for iPhone sales, the stock is horrifically underpriced. If Apple's going to start increasing sales by 15 to 20% a year on iPhones, you know what I mean? Like, they're really underpriced here, and the stock didn't budge.
Well, I mean, to be fair to that, the Qs were down over 1% today, but
yeah, I mean, I know, but you had plenty of stocks in Google was flat. There were plenty of stocks that hung in there.
Yeah. It definitely would be up more than this. Let's see. So their America's sales growth was up 11, Europe up 13, Greater China up 38, rest of Asia Pacific up 18. But part of it's too, like they had a big lull for like 2 years. So part of it's just a normal refresh cycle, and kind of like a base effect of like, you did bad, now you're doing decent, so it looks like you're doing amazing. So it could be that simple. I find it interesting that they're basically just handing their AI keys to Google at this point, like full stop. Like, and they had another, I think, 3 AI engineers walk today, and I saw the headline and I was just like, well, of course, like, they're not really doing AI anymore. Like, why would you be there while they just surrender AI to another company to begin with? Like,
yeah,
that may not be a bad thing for them. That may be a smart thing to do.
Look at the ventures they've taken out into new sectors and new products. I mean, I would say it probably is. I mean, if you look at the track record, if they're trying to branch out into somewhere new, chances are they're just going to blow a bunch of money on R&D. I mean, I mean, I don't. That's just. I mean, that's been the way of it. I mean, you look at the VR headset, the car. I mean, that's since Cook's taken over. That's been their MO.
Yeah, I mean, their AI capex is nothing. in that standpoint, they may be like a place to hide. If you're terrified of AI capex and you want to own big tech, like Apple should be the place for you because they're not going to do it.
Well, yeah, look, if big tech starts getting hammered because of the capex, I think Apple on a relative basis probably outperform them significantly.
Right. It's
Yeah.
for no other reason than it ain't doing it.
Yeah, I mean, I still don't find it a very attractive long.
Not at the valuation. Yeah.
No. And like I said, those iPhone sales don't do anything for me. What do you have? What about war? So what Fed appointment today? What do you make of it? We haven't even discussed that.
Yeah. I won't pull any punches. I think Kevin Warsh is a very, very bad hire. And I don't like the guy at all, personally. Full stop. Like, now, does it really matter in the grand scheme? Probably not, because, that I just don't think he's.
If you had to pick between him or Waller.
Yeah, if I had to pick, it would have been Waller. So if you
Really?
took the 4 candidates that it came down to, Warsh would have been my last by a mile. I know some people that kind of know him a little bit and know people that know him and stuff. And yeah, he's a very political animal. I don't trust his expertise. I don't trust his prior time with the Fed. If you go back and read the transcripts from his time there, I mean, it's just a brutal indictment of his understanding of the economy, of monetary policy, but obviously I think this guy's going to do what he's told. And I think that's why he got hired. But what I think Trump needs most out of that is someone that can bring the rest of the committee with him. That's where I think this hire falls the most short, is because this guy was like a rabid hawk during the GFC and stuff. And how do you, to watch a guy go from mega hawk to mega dove is just, it's, obviously that's not very credibility inducing. So it's going to make it hard for him, I think, to bring other people along. But we'll see.
Yeah, I read some comments or some analysis of him, I want to say from the summer of 2009. And look, I feel bad judging the guy by this because I didn't go into big detail, but I mean, they were direct quotes.
I read all the transcripts from the period. It's bad.
It was laughable. I mean, I'm just sitting there going, "Where did you guys just hire this guy from Econ 101? Like, what are we talking about?" We had 10% unemployment.
Right.
We had 10% unemployment. He's in the middle of the GFC and he's talking about inflation. He thinks is under wraps, and you're sitting there going, yeah, inflation's not the problem, bud."
Right. There was a point when inflation was 0.6 and unemployment was around 10, and he was still more worried about inflation than labor market. You're just like, what?
Yeah. Just be like, hey, you ever heard of Hoovervilles, buddy? Should we get rid of deposit insurance while we're at it? Let's raise rates, man.
But now he's the opposite, talking about the productivity boom and how rates are too high, and so it's going to be interesting. Unemployment at 8 was no big deal, but now that it's 4, that's too much. We got to cut rates. But we've talked about it a lot. At the end of the day, it doesn't matter because there's 12 of these people that get a vote, and he doesn't get 12 votes or 10 votes or 8 or 2 or 3. He gets 1. So.
I saw one of my favorite Twitter experts. That's an idiot, and he was talking about how this is really going to make the economy run hot and this and that. And I'm like sitting there going, so did we award him all 9 positions on the F1? Did he take all those positions? He doesn't have all the vote. Like, what are you talking about? And so anyway, I mean, to put it in perspective, the last vote they had, we had 7 people voting to not do anything and 2 voting to cut, right? Okay, so everything held equal. If he's sitting on that, 10 to 2, that's right. There's 12. Okay, so instead of 10 to 2, now it's 9 to 3.
Right, and I don't even think Waller would have voted that way if it wasn't for him.
Right.
Obviously, Mirren's going to do the same thing. Those two are going to vote yes every time for the cut. Him and Warsh.
Hey, don't be bashing on my guy Mirren, man. He's a know your risk podcast guest. Don't you go doing that, Chase. No, I really like Steve. I think Steve's a really good guy, really sharp guy. I will admit I don't understand. Like no, I do understand. The one thing that I think makes sense is if they're having the conversations behind closed doors and acknowledging that we've got to run this hot. My only dissent from that is if that is your point of view, come out and say it.
Right. And the problem with that point of view is whether you say it or not is it, and this is unfortunate because if your conclusion is that's what you have to do, but you can't win elections with that. Like you can't. So you can look at the polling. People are not very happy about inflation and stuff. The problem is people aren't
Yeah,
going to
no,
be
no,
happy with any real solution. So
no, I know, and that's why I said that I think that and I said at the time that the way the Trump administration was addressing inflation right out of the gate, I thought was a big mistake, a big political mistake, because what it should have been is the messaging, in my opinion, from just a political standpoint and understanding the dynamic. Like, forget about whether you like Trump or don't, right? Let's pretend let's pretend we're one of his advisors. He puts you and I on his economic council. We're getting and first month in office, we're sitting in there January 15th. He's about ready to get or inaugurated, right? And we're having a conversation with him. I'm looking at him and saying, listen, inflation is a grease fire historically, meaning you think you got it put out, it pops back up. Our number one goal, we know that dealing with inflation is going to be tricky because we can stamp it out, but doing what we know stamps it out will probably throw us into a vicious recession. So let's work on the optics first. First of all, out of the gate, we're going to come out and we're going to be talking about the inflation problem all the time. And we're going to position ourselves to be like the sanitary workers. We're the garbage men. We are the disaster cleanup crew that is here to deal with the mess that has been created over the last multiple years, specifically in the last 4. We're going to need to do this and we're going to need to do this. Here's going to be the cost. All of it isn't going to feel good, right? But these are the things. We can't cry about spilt milk. We got to go forward, right? And keep messaging it that way. I think if you would have done that, it would have bought you the rope needed to tell people what was actually going on. Because I do think that. I think that especially if you're Trump or if you're any type of politician that's going to try to do things differently, right? Like if you had a guy that was going to really try to capture the middle or the moderates, I think a part of that needs to be having way more candor and transparency in what you think than is traditionally the case with most politicians. We can go back to that. We said when I knew Trump had won the presidency the first time is when he sat there on the stage and told Hillary Clinton, I know it works because I paid you, right? Meaning I think that proved what I'm saying, which is
right.
What the constituency wants is way more authenticity than they have in the past. Go back to 1960s, voters wanted to be told a story. Look at it today, they don't. There's a much greater desire for altruism and authenticity. So anyway, it's a political critique, but it's one that it's weird to say it play out like this because right when we're going to get inflation licked, we've got this thing, no problem. And I'm just sitting there going, why would you say that? Nobody's ever dealt with inflation lickety split like that. It's just, like I said, it's a grease fire. It's a mess. It's not like, and that's, I think, what makes it more complicated than deflation, because usually deflationary things happen like this, Chase, right? You go down and then you start the road back up, right? Like inflation just does that to you, man. It just keeps beating you up and beating you up and beating you up and coming back when you think it's dead. And I just thought it was really bad, dumb messaging right from the jump.
Yeah, and I think they're very much struggling to even improve upon it lately. But there's something I want to address on this real quick, I'm starting to see some of these 4D chess grand narratives built around Warsh and Besant working together, and it's like it's along the lines of like running it hot, but only for the right parts of the economy, letting Wall Street, have a problem. And so here it's basically like lower rate that favors debtors, less liquidity drives money into bonds out of stocks, pops the asset bubble. So you can, reallocate the money to the military and the capex and reduce the interest burden on like regular people. There's like this grand narrative that you can have the bubble pop and keep everything else really good and in line. And if anyone's out there that has read some of this or heard some of this and you're like, yeah, well, that sounds like a good idea. Let the bubble pop. but let Main Street win, and then we're all going to be okay. I really wish that was the case. The problem is the system dynamics of if the top crumbles, it's going to cascade down at every level. Like it's too much of a piece of the whole economy now, and sadly, wealthy people's spending is way too important to the economy. Like the whole thing will cascade down. Like if you take rich people's money away through blowing up the bubble, then or popping the bubble, like that will find its way all the way down to working class people, like big time. We'll be back to 10%, unemployment and 0.6% inflation, like Warsh was, dealt with like that last time. So just
the other, and I really don't care what side of the political aisle you're on. This is a reality. The other thing is you have to look at the political reality we're facing. And if you are a reasonable human being, I think you can see that an economic outcome like that greatly increases the chances of having 25, 29 people on the Supreme Court, a government 5 years from now that we really don't recognize. Meaning, when you've got a situation where extreme elements of the political landscape right, very extreme takes have become commonplace, right? The tales of both sides of the deal are louder and feel more confident being louder probably today than at any other time in history. And I think that one of the things history tells you is when staring in an environment like that with extraordinarily, and I think you could say in a lot of ways, unprecedented conflict, right? Internally here in a country like the United States, the risk of economic issues is amplified massively, right? Because like I said, I mean, you can hate Trump. No, this is great. You can hate Trump all you want. I am just telling you, if the cost of getting Trump defeated or whatever that means, if the cost of quieting MAGA is the institution of a socialist system here in the United States, we all lose. You may not think you do, but we all lose. And I just think that one of the things that you've got to think about is, I am abnormally susceptible to that just pop the bubble argument, rip the Band-Aid off. It's the way I approach things in my own life when I know there's a problem. Let's just deal with it head on right now, right? And it's never pleasant, right? But the beautiful thing about it is you get through it quicker, right? You get out the other side faster. I think there's too much at risk. I just don't think I don't think culturally and politically we can handle that.
It is so the right thing to do for the country is to let the bubble blow up and start rebuilding, from the ground up in the right ways. But you're right. Like that ignores the systemic part of it, the way the system works, all the knock-on effects and everything that are too big, too destabilizing. So it has to be a controlled demolition. It has to be, the way China has allowed their property market to go down without it being like too violent, stuff like that. Like we'll have to do something like that. And this whole notion of like, oh, that's what they're gonna do, and that's that's smart. And it's like, come on, like Bill Ackman and the All In podcast fellas would be, I mean, just they would be on air just savagely crying for the Fed to buy QQQ, with QE fast in that environment, and like it's just not gonna happen.
So would all the constituents, man. I mean,
everybody.
We
all have a lot riding on it. Everybody in the country does, whether you realize it or not. If you're Joe Sixpack and you have $0 in the stock market and you work for $30 an hour with your hands, it's still coming for you. Which
really pisses me off. And here's what pisses me off about it. This is the exact, and I've said it a million times and it bears repeating. This is the exact scenario we were saying that over involves central banks we're going to create, is this scenario where now all of a sudden no stimulus is the problem, right? The car is shaking because it doesn't have stimulus, rather than, apply stimulus because there's a problem. No. Now you need stimulus just for the wheels to roll.
And to be fair, not just the Fed, because running these giant deficits,
right?
Congress passing all the laws that link everybody's well-being to the stock market, and like it just, you combine all that and you're left with a wildly over financialized place, and that's
Yep.
it has consequences. So
Yeah. And you know what? For all these reasons too, silver is a tougher one for me, and you and I have talked about it for all the reasons that we're discussing. And I think it's really good to bring it up. Everybody likes to cheerlead things when they're going up, but on a day like this, yeah, it is ugly if you own gold. But for all the reasons we just discussed, that's why it needs to be a part of your portfolio, right? Like,
yeah,
just
100%.
the choices that we have in front of us aren't good, and gold will continue to benefit from it. And do not freak out. What you are seeing today in gold, the reason it's dropping so much is because it went up so much. This is what it does. It's going to make climbs up, and it's going to pull back, and it's going to retrace. The more the upswing is, the more painful the retracement gets. It's just part of the game. You got anything else to add to that?
Nope, good to go.
All right. I do not have anything else either. You guys have a wonderful weekend. As always, we will be back on Monday. I will be coming live from Phoenix, though, out of town. I am playing in the Waste Management Pro-Am next week, which I'm jacked about. It's like golfer's paradise. I know that means nothing to you, but you get treated like a PGA pro for a day, and you get to play with the guys on tour. Last year, we had a celebrity, Michael Phelps, last time. That was pretty cool playing with him. Cool guy. We had a really fun time playing with him. But anyway, doing that on Wednesday. So we're taking the fam down with us. We leave on Sunday. So I will not be able to do it. You're going to have to run solo on Wednesday, but I should be good on Monday. So you guys have a great weekend. We'll see you then. You can follow Chase and I. I'm at KYR Radio on Twitter. Chase is at Pinecone Macro. Go to YouTube for the video feed. Just search Know Your Risk Podcasts. We'll see you Monday. Have a great weekend. You're listening to Know Your Risk Podcast. Download and subscribe to KnowYourRiskPodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.